Welcome to Yahoo Finance Live, and happy Friday to all of you. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action with just 1 hour left to go in the trading week. We've got a bit of a rally on our hands with the Dow up more than 300 points right now, the S&P 500 up 39, and the NASDAQ up 145. Energy leading the gains in terms of sectors that we're watching, but of course, bond yields very much in focus given the comments that we got from Fed Chair Jay Powell out of Jackson Hole. Right now, we've got the 10-year yield moving up here at 4.24%. All of this, of course, as investors digest those comments coming out of Jackson Hole. The Fed chair making it very clear that he's keeping all options open given where inflation is right now. Take a listen to some of the highlights in our coverage from the Fed's Economic Symposium today.
We are navigating by the stars under cloudy skies. 2% is and will remain our inflation target. We are attentive to signs that the economy may not be cooling as expected. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level.
I thought it was moderately hawkish. The chair's very careful in assessing the situation, as is the committee, and they'll be data dependent. But right now, it looks like the data is not cooperating the way they would have thought. That sounds like a higher rate path than what you would have otherwise thought.
For me, putting pressure on the economy, which we've done, I think we're in a restrictive stance, and keeping that pressure on is, from a risk balance perspective, to me, the right thing to do. We clearly are going to hold through the end of the year, right? Next year, we need to let the data dictate that. We need to see clear signs we're moving toward 2%. Now, our view is we're going to get under 4 this year, under 3 next year, and in 2025, we'll hit 2. It's going to take some time.
Some Fed officials there speaking to our Jen Schomburger out on the ground in Jackson Hole. Diane, looking at what exactly we heard from Jay Powell today, it wasn't entirely new. He kept all his options open. I think the clear line, he says the process still has a long way to go in terms of the effectiveness of the tightening cycle for the FOMC. He says even with the more favorable recent readings. And then this line, I think a lot of investors have been watching to see what this all means for the economy moving forward. The chair saying the wide range of estimates of these lags suggest that there still may be significant further drag in the pipeline, but interesting to see the market reaction.
It is.
The Dow up more than 300 points with about an hour left to go.
And listen, you saw the market. So the market initially was optimistic as he began speaking, and it was a bit of a head scratcher to me because it sounded like, yes, some people would say it was kind of a neutral speech, and he was straddling the fence on both sides, leaving the door open for the potential for further tightening. But again, just that data dependent message. So, but the theme that it seems that sticks is this higher for longer. We haven't seen this all work out in terms of the economic picture yet and the impact to where the Fed wants to see inflation reside. And again, that talk of 2% and moving away from that target, that's not going away. I mean, Fed Chair Jerome Powell reiterating 2% is the target. That's it. Not 3%. Not anywhere near there. So the next FOMC meeting is just over 3 weeks away, and a common theme we've heard out of Jackson Hole today, you've heard it before, the Fed will be data dependent when making decisions on rates. The Fed will digest a number of economic reports before the September meeting. Yahoo Finance's Josh Schaefer joins us now to break down those reports ahead. Josh?
Yeah, Diane. So the biggest thing that stuck out to me from Fed Chair Jay Powell's speech today was he was talking about being attentive to the stronger than expected economic data. And this is one of the first things he mentioned when he said that was GDP, so how much the economy is growing. And when you take a look here, you can see the economy in the second quarter grew at a 2.4% pace. That was not expected at the beginning of this year. People were expecting this to grow significantly lower than that, if not turn negative. A couple quarters in a row of negative normally would mean we're entering a recession. Now, I should note, for the next quarter right now, expectations are for the economy to grow maybe at even double this pace. So right now, you're seeing the economy essentially expand, and that's something he was highlighting. And what's fueling that right now is the consumer. That's a big part of GDP. So when you take a look at the July retail sales number, we saw another tick up. And when you look month over month at what retail sales have been doing this year, you see the last several months, the consumer has been very, very strong and rather resilient. It's not what we saw way back when, but still resilient and not negative. And that's something that the Fed chair was really pointing out. And where does this come from? Well, it comes from the labor market, right? And that jobs report that we follow each month. You take a look at the jobs report, we've sort of been in a range here for most of the year, just below 200,000, maybe a little bit higher, maybe a little bit lower. But this is another key number that the Fed is following and economists are following to see if we get a slowdown here, because we have not seen a big slowdown out of that range right here. And another thing the Fed chair often points to is labor demand versus how many people are being hired. So when you take a look at this is the total non-farm job openings, this big line up here, and then you see this blue line, which is hires. You can see historically, normally these numbers are relatively in line when we have the labor market that the Fed is looking for. Right now, there's a big gap here. So that's what the Fed is currently looking at to see this come a little bit closer. And we're gonna get all of this data, important data, next week. So when you think to next week and what we're gonna be able to take a look at then, we're gonna see data on inflation, core PCE, and we're also gonna see job openings. And really what the Fed is going for is core inflation to come down, right? So when you take a look at this PCE number that I said we're gonna be getting next week, that's in purple here at 4.1% in June. The Fed wants that to come down to 2%. That needs to come down a long way to get down to 2%. And so that's something that the Fed is watching when they think about jobs data, when they think about how the consumer is doing and how much it's growing, is to get inflation down. Next week, we will get a jobs report and a PCE print. So we're expecting PCE to actually not come down at all, core PCE to actually move up to 4.2% in July. And we're expecting 170,000 non-farm payrolls to be added in that August jobs report that is expected next Friday. So as of now, we are not expecting to see that slowdown quite yet. And remember, that Fed meeting is coming in September. Right now, it's not priced in for a hike in September, but the prices for a hike in November, guys, is starting to pick up a little bit, hovering around 50% now of investors betting that the Fed will hike one more time in November.
We will certainly see if the direction changes in terms of expectations, especially when you see, PCE is the Fed's preferred gauge. So we'll be watching that. Thanks so much, Josh.
Well, markets taking Powell's somewhat hawkish tone in stride, looking to end the week on a high note. Jared Blickery is on the floor of the New York Stock Exchange with a look at some key movers on Powell's speech. We have seen bond yields all move higher, Jared.
Yeah, bonds are really interesting. I'm going to go and break down first the intraday movements, and then I'll show what's happened over the week, because some pretty interesting things going on. First, looking at the S&P 500, this is intraday. This is what happened. First, we got a little spike up when Powell started speaking, then we got a spike down, and then we drifted up for the rest of the day. Now, remember that pattern, because what happened in bonds was the opposite. First, we went down, then we spiked up, and then we drifted down throughout the rest of the day. So you can see we're about actually exactly break even. So the 10-year did not move today. And then also taking a look at currencies, those followed the pattern of bonds. You can see we went down, up, and then drifted down. And finally, I was looking at Bitcoin. I like to see what Bitcoin does on these days, and I'm not sure it's following anything. It just kind of spiked up, came down, and it's hovering at the bottom end of its range there. So really not too much like other currencies or equities. But nevertheless, this week has been really interesting in terms of rates. I was showing you what happened today, but let's show a 3-month chart of the 10-year, and you can see we are actually net down for the week. However, if you look at the 5-year, we are net up a little, and so the lower part of the curve, the lower maturities, those have risen as much as 10 basis points when you look at the 1- and 2-year maturities. Meanwhile, the 30-year at the long end, that has sunk. So we have a widening of the yield curve. Generally, when that happens, that is supportive of stocks. Now, here's what's happened in sector action. This is showing XLK up 2.4% for the week, followed by consumer discretionary. So tech and consumer discretionary and then real estate are the outperformers here, each of those up more than 1%. When we take a look at leaders, guess what? Software ended up as number 1, followed by New York FANG, then we got China, then we got Korea, then we got biotech, kind of a sleeper, and also disruption. A lot of those sectors did well. NVIDIA, of course, a huge, huge topic for the week. That has ended up 6.5%, but you can see over the 5 days, there is some red price action. And in fact, after that announcement, you can see over the last 2 days, we are decidedly red in chip stocks. But I mentioned software was a bright spot. Here's the 5-day look here. And you can see, except for Oracle and Datadog and maybe a couple couple others largely in the green. So software emerging as one of the bigger winners of the week, guys.
All right, Jared Blickwery with a roundup there with just about under 45 minutes left to go in the trading week. Thanks so much for that.
All right, well, speaking at Jackson Hole this morning, Federal Reserve Chair Jerome Powell said the central bank is, quote, prepared to raise rates further as it continues its fight to bring inflation back to its 2% target. For more on how it's impacting markets, we welcome in Brian Mulberry, Zacks Investment Management Client Portfolio Manager. So thanks so much for joining us today as we kind of digest and process what we've been waiting all week for. First of all, what was your initial reaction to his comments today? Was this a hawkish, Jerome Powell?
It was slightly hawkish. I think he did a really good job kind of laying out the case between the short-term data, the trend over the last couple of months showing prices coming down, but then the comparison over the longer term, looking at a 12-month look back, prices really aren't getting down to the 2% target that he's looking for. And he did reaffirm 2% is the number. There's been a lot of conversation about maybe we should just accept a new normal. And he was very clear today that that's simply not the case. And they're going to start moving monetary policy towards that 2% target no matter what. And so we absolutely agree that monetary policy likely gets tighter by the end of the year, either in September or November. But the biggest thing is that there's clearly no room for a pivot at this point in time. And I think that's a lot of what equity markets have been pricing in at the current valuations is a little bit of easing in the next 12 months. And it might very well be that that higher for longer case says we don't get anything until the middle of next year.
The middle of next year, you mean that as in a cut?
Correct. Yeah, we don't see a pivot in policy maybe until the end of Q2, beginning of Q3 next year. Again, there's been a pretty big discrepancy between the actual data and the forward-looking surveys. And I think that's what Chairman Powell was really talking about today when he talks about being data dependent. And we're kind of curious. He laid out a number today. He said July PCE was 4.3. We're wondering if he kind of front run that number that we're supposed to get next week. Again, you just saw that your expectations was 4.2. I think that's pretty widely accepted in the market. So he didn't really qualify it saying we're expecting or it could be or something like that. He just kind of laid it out on the table that core prices really aren't moving at all. I think we've enjoyed the headline numbers coming down that reflects the goods inflation going away. That's kind of the easy prices getting out of the way. And now we're stuck with the more sticky side of inflation, which is on the services side. And he's just been very clear that if that remains the case, then interest rates will simply be held higher for longer than the equity market is currently pricing in.
So let's break that down a little bit more. As you pointed out, core goods inflation is the good news, the good part of the inflation that has come down. You talk about non-housing services sort of moving laterally. That's what the Fed chair highlighted. He also talked about the concerns in the housing market, that prices have started to pick up again. And that is the concern about sort of the reacceleration of inflation. How do you look at that data and how big of a concern is reinflation overall?
Well, and that's part of where we've seen the durability in the consumer right now. There's absolutely been no real let up in the level of consumer spending. That retail sales number that we just saw a little earlier has been so durable, and that's now coming back into the housing sector itself. We're seeing people able to pay those higher rents and higher mortgages after rates going up substantially in the last 12 months. And so that definitely is a concern. If the consumer is just going to shrug off the cost of capital at this point in time and continue to grow the economy, again, looking at that GDP assumption of north of 5%, that definitely implies that the economy and growth in the economy is accelerating. And that's the opposite of what the Fed wants in this moment of time in order to bring prices down.
So I want to ask you, Brian, when we look at today's market action, though, this doesn't seem like the reaction to a hawkish Fed, like one that could potentially raise rates at the September meeting. Is the market pricing the Fed's expectations correctly?
In our view, no. I think they're pricing in that pivot in policy sooner than later, and we just simply don't agree with that. Again, looking at the trends in the data, it's showing either a sideways move in prices or maybe even an uptick over the next couple of months. Again, that's just simply the wrong direction, and Chairman Powell was very clear that they want prices to get back down to that 2% level. And so all of that combined together tells us that the market is getting a little too hopeful in what rates should look like. On the bond side of things, they're looking at the 1-year treasury by the end of 2024, still in the 4.9 range or so. So the bond market's only implying 1 or 2 rate cuts by the end of the year. Whereas, we even had Goldman Sachs come out last week and say, hey, we think that the year-end rate 2024 should be closer to 4%. And that implies, maybe even 4 or more rate cuts throughout the year. In fact, they even said 1 per quarter throughout the year in 2024. We just simply don't see that happening in the data the way that it's currently being formed. Now, if we're wrong, we think it will show up more than likely in the labor market. Then you would start to see really big shifts in the job openings and job losses from what we have seen over the last year. So if that recessionary window starts to open up, it will first show it, I think, itself in that labor market. And right now, it's just been kind of treading water. We're slightly losing jobs every month or so, but not enough to bring air out of the economy or the consumer so that they spend less money so that prices would come down.
Yeah, so Brian, on that front, you talked about the durability of the consumer, but as we kind of wind down earnings season for the second quarter, we've seen a number of retailers raise concerns about the health of the consumer. Cautious is the word we keep hearing, and we've seen those retailers reduce some of their sales estimates. What's been your big takeaway from earnings season in terms of the state of the consumer?
Well, again, just looking at the level of spending, the state of the consumer is stable for now. We did see a little bit of a downtick in consumer confidence, but it's still at 69.5. That reflects a much different view from where you're looking at things in terms of like manufacturing and the PMI indexes. So there's some stability still there from the consumer's point of view. Now, there are concerns that there could get softer sales by the end of the year, or maybe even just the end of the third quarter. And then again, it reaccelerates by the end of the year. The biggest window for us, again, is looking at the labor market. As long as there are more people working and making more money, then they seem to be confident spending it. And keep in mind, as prices have come down, even Chairman Powell reflected this, that real wages are starting to go up. And again, that's that reacceleration in growth in the economy that he's being really wary of. And so we're definitely at an inflection point where it comes to the consumer. And the Fed is obviously trying to engineer a very delicate decline in that consumer spending so that we don't create a hard landing recession. There's no question about that. And the results obviously are going to be reflected in the data. It's just the rate of change that we have to study so carefully to make sure that, monetary policy hasn't been too restrictive for too long. And at the moment, it doesn't seem like it has been. So it probably just seems like we just simply stay at 5% or higher for longer than the market is currently expecting.
And one of the sectors that's expected to feel the impact of higher interest rates is the tech sector. Now, one stock that it's been a standout, one stock in particular that's been a standout has been NVIDIA. Its shares are lower today after that massive earnings beat this week. Now, a note out from Bank of America this morning is saying they're expecting the tech sector to see some losses as artificial intelligence could be overshadowed by the effects of this higher for longer theme of interest rates. What are your expectations long term, Brian?
Yeah, absolutely. There's no question. When we look at that R star, the neutral rate that has been in the economy for a long period of time, if we look at the last 15 years, going back to 2008 and the global financial crisis, we had rates go down and some quantitative easing that even made the real cost of capital even lower. And so over the last 15 years, it's been like rocket fuel for growth. And that obviously helps the technology sector almost more than anybody else. When you have cheap, easy capital that's available, it's absolutely done wonders for that particular sector. If we're simply going back to a longer term normal, where we go back over 80 years and where interest rates are likely to be, the 10-year should be around 3 to 3.5%. And that should reflect more of where, the Fed funds rate is on an overnight basis as well. So if that's simply going back to a rational valuation of interest rates, it means that there's going to be winners and losers in the marketplace, so that the cost of capital isn't restrictive at 5% when you have to borrow there, but it is going to have an impact on your bottom line. So if you're not a good steward of your revenue coming in the top end of your balance sheet and managing that cash flow well, then you're going to show it in the bottom line number in profitability. And that's why it's going to weigh on technology in general. Now, NVIDIA is kind of a rare case of its own. We're seeing earnings in the overall market in the low to mid single digits in terms of earnings growth, but they're growing at a gigantic pace. The thing is, their stock price has already enjoyed the next couple of years worth of earnings growth. When you're talking about a PE of 230 or more, it's up over 200% for the year. Gigantic numbers, a huge beat, but basically Wall Street has already priced all of that good news into the level of where it is now, and maybe even some more. There's also going to be, some concerns around the announcement of $25 billion in a share buyback. Our question would be, hey, if demand is so high, why wouldn't you invest that capital in further capacity so you can continue to capitalize on these great earnings beats and grow your revenue even more over the next couple of years? So maybe there's a different view out there for that revenue, but that's kind of a question there. So we're watching very closely what's happening in this particular sector. Because of the high costs of capital, it's going to come back and favor those companies that are good with their revenue. They have cash on hand and they're not over leveraging their balance sheet.
Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Appreciate you joining us today. Have a good weekend.
And you. Thank you so much.
All right, we've got some company news here. Grocery delivery app Instacart filing to go public. The latest sign the IPO market is starting to thaw. Yahoo Finance's Brooke DePalma is here with the details. Brooke.
Good afternoon, Diane. I mean, this is pretty exciting. The IPO market seems to be making a comeback here. Instacart, the latest company to file its plans to go public on the NASDAQ under the symbol CART, CART. Taking a closer look at the numbers, the company began generating profit at the end of 2022 after being unprofitable in 2020 and 2021. The company said that was driven by diversified revenue streams, including growth in their ad business. Today, the company has more than 5,500 brands using Instacart ads. That includes up-and-coming names like the prebiotic soda Poppy, as well as Jennifer Garner's business Once Upon a Farm, both highlighted in the S1 filing. Another interesting part of the S1 filing here is that PepsiCo plans to buy $175 million in convertible preferred stock. The company, however, did not disclose the total price and size of the IPO, but we do know that back in 2022, Instacart did in fact cut its valuation 3 times a reported $13 billion. Now, the CEO said that they're focused on the long-term vision to power the future of grocery through technology, and when you think about the scope of Instacart, it is the biggest U.S. online grocery delivery company. They have 7.7 million monthly active orderers who spend approximately $317 a month on average. They also have more than 1,400 national, regional, and local retailers that use Instacart. In addition to that, this company really came, to consumers and Wall Street and Main Street's mind during the pandemic when momentum certainly picked up. We saw gross transactions jump 300% between 2019 and 2020, but it's now getting more steady from 2020 to 2021. Gross transaction value jumped 20%. That then decreased the following year. But something worth noting here is that while orders increased in 2021 and 2022, they did remain consistent from both 2022 to 2023. And so that consistency is interesting there after such a large ramp up during the pandemic. But for some of its in-store partners, they highlighted regional retailers like Publix and Wegmans. They did say that what they see with users on Instacart is that they are ordering more than in store. And so lots more to come on Instacart, potentially going public or filing to go public, that is, as it makes its public debut. And we'll be watching all of it.
All right, Brooke DePalma, the latest in the Instacart and the IPO craze. Well, not craze yet, but coming back out of the woods.
What we saw with Kava, I mean, they were valued at $4.8 billion. So this really could be the rumbling of a comeback in the market.
That's right. There we go. Brooke DePalma. We're just getting started here on Yahoo Finance Live. Coming up, Amazon in early talks with Disney regarding an ESPN partnership. More on what that could mean for the streaming landscape on the other side. Plus, Warner Brothers has decided to push back the release of its movie Dune Part 2. Could this be the first of many box office casualties of the Hollywood strikes? And we continue our coverage of Jackson Hole following comments from Fed Chair Jerome Powell today Former Fed Vice Chair Alan Blinder, IMF Chief Economist Pierre-Olivier Gouronchass, and former Kansas City Fed President Esther George will all be joining the program in the 4 p.m. hour. You don't want to miss those conversations.
Amazon is reportedly in talks with Disney for a potential streaming partnership with ESPN. The information reporting that the two companies have discussed pricing for the service, with Amazon exploring a minority stake in the sports network. So what does this all mean for the sports streaming landscape? Here to discuss, we've got Axios Media Deals reporter Tim Basinger. Tim, was this a surprise? It seems to make sense given the sports offerings Amazon already has.
Yeah, in some ways, it's not much of a surprise because, I mean, if you look at a lot of the recent reports in terms of how to figure out the future of ESPN, I mean, Disney has been very open that they are looking for some kind of strategic partner. They've held talks with multiple different companies. You know, they've held talks with every single professional league, the NBA, the NFL, Major League Baseball, the NHL, obviously Amazon. They've held talks with Verizon. So they're clearly looking far and wide for someone to help them with this full streaming version of ESPN.
And Tim, when you think about pricing, especially we've seen some data recently about some of the churn that's happening as people kind of get subscription fatigue over all these subscriptions and where ESPN may end up being the potential cost. Now the potential cost if it's rolled up into Amazon. What are you hearing about pricing, especially when you think about subscription shock?
I mean, it's fair to assume that a full streaming version of ESPN is going to be easily the most expensive, streaming service on the market. I mean, you've seen the numbers. It could be anywhere, but they're talking between, $20 and $35 a month, which is well more expensive than, pretty much anything else out there. And obviously the current version of ESPN's, streaming service, ESPN Plus, I mean, that's only like $5 a month. And they're making far less money off those subscribers versus the people that, subscribe to ESPN on cable television. So a full version of ESPN's streaming service is going to have to cost a lot more because sports rights are not cheap. They're only going to get more expensive. ESPN not only is, going to probably renew its NBA deal that's up in a few years, it has its SEC football deal that's going to start, pretty soon. So their costs are only going up.
Tim, it really, things have really moved quickly when it comes to sports and streaming. Obviously, Amazon's had that deal with the NFL. You've got Apple with the MLB as well as MLS. What's the verdict so far, you think? I mean, if for so long it was about the only reason to keep cable, to keep that cord, was sports. And we've seen a lot of those move over to the streaming side.
Yeah, I mean, that was, I would say about 5 or 6 years ago, that was the kind of talk you always heard, was that sports were the one thing that was kind of holding the paid TV bundle together. And while sports, especially the NFL, still get big viewership, it's turned out that people are still cutting the cord, moving to streaming, dropping their cable subscription. So it makes sense that sports is moving over to streaming. Now, I would describe what's happening as more of, it's a lot of experimentation. I mean, the reason that Thursday Night Football went to Amazon was because it was on CBS, it was on NBC, it was on Fox before, and none of those networks really did that well with it because, one, it had to be simulcast on NFL Network. And so it's really on Amazon because, frankly, a lot of the broadcast networks that have been NFL partners for years, they didn't really want it.
And Tim, I want to ask you, Akiko mentioned Apple. I know there had been talk about Apple potentially kind of bringing ESPN to its fold. Have you heard any recent talk of that, especially when you think about what's happening now with Amazon?
I haven't heard, that talk, but it wouldn't surprise me if it was happening because as I, said before, it really looks like Disney is talking to everybody in terms of how to help with ESPN. I mean, Disney CEO Bob Iger in their earnings call a few weeks ago, he mentioned one of the key things that they're looking for when talking for a strategic partner with ESPN is someone to help with distribution. Obviously, Amazon, Apple really kind of make sense in a lot of those ways.
What do you think this means ultimately? And we should preface this by saying this is a report from The Information. Disney hasn't necessarily come out and said, yes, we're teaming up with Amazon. But when you see where sports is moving in the streaming landscape, what does that ultimately mean for the viewing experience moving forward? Sure, we're used to sort of, channel hopping on sort of the traditional TV, but this is about subscription streaming services that viewers will need access to.
Yeah, I think you're going to see sports moving into this kind of bifurcation where more games are actually going to be on broadcast television. I've talked to my sources that are involved and have knowledge of the NBA's discussions that they're having is, they want more games to be on ABC versus ESPN in the next deal. And what you're going to happen is you're going to see a lot of games, a lot of big ticket games move closer to broadcast. You're seeing it on the local side with some NBA teams like the Utah Jazz and the Phoenix Suns, and in the NHL with the Vegas Golden Knights. They're taking their local television rights away from cable and moving them to broadcast. At the same time, there's this other wing that's going to be subscription, whether that's some subscription companies or some streaming companies that are going to simulcast what's on broadcast television, or you're going to see what's happening with the NFL and Amazon, or more specifically the MLS and Apple, which kind of went to they'll have some games on Fox this season, but they're mostly going to a full subscription streaming model with Apple. And I think big picture, what you're seeing is a lot of these leagues are going to be faced with this decision that used to not be a decision, which is you can either reach the biggest audience or you can make the most money. I don't think anymore you can do both.
It'll be interesting to see how that all pans out, but it's good to get your take today. Tim Basinger with Axios. Appreciate your time.
Happy to be here.
Well, coming up, Warner Brothers deciding to push back the release of its movie Dune Part 2. Could this be the first of many box office casualties of those Hollywood strikes?
The Hollywood strikes taking a toll on Warner Brothers' upcoming movie slate. The studio delaying the release of Dune Part 2 from this November to March of next year. It's bad news for the studios, but our next guest is getting a bit more bullish on the theater business. She just upgraded AMC's stock and predicts the domestic box office will see a bounce of 22% this year. Joining us now is Alicia Reese of Wedbush Equity Research Analyst. Alicia, thanks so much for joining us. So first, what's your thesis for this for AMC, especially when you consider this has been a meme stock trade?
Yeah, so, we rode the underperform rating from $40 2 years ago all the way down to $2 just yesterday, but we got out of the way, maybe a little too early, perhaps. But our view is that there's, potentially a bit of a cushion here. And one of the reasons for that is improving fundamentals. And I don't think that's very arguable. The other side that is a little bit arguable is that there's remaining retail traders in the space that could continue to provide a premium valuation on the stock. It's certainly getting pushed pretty hard the last 2 days. So we'll see how far that goes. But a big portion of our premise is that AMC can repay a decent portion of its debt while the stock's trading at premium levels. If it waits too long or if the stock collapses before that, there's still quite a bit of downside. For instance, without the debt payment, and if AMC returns to a fundamental valuation, no longer getting that premium multiple, it could trade as low as, in the $2 to $10 price range. If it does pay off its debt, however, and they can do so or pay down the debt at a significant level where the price is above $9, they could go to, say it's at a $12 price point, for instance, where it's trading today. They can issue over 400 shares and then get to a fundamental trading range of $8 to $10, and then, return to paying a dividend and repurchasing shares from there. And with positive industry fundamentals, that positive backdrop, that would be really positive for them, I think, overall.
So there's the immediate concern about debt, as you highlighted, which investors are focused on. But at the end of the day, this is a business that's built around theaters. You need bodies in those seats. Things have moved in a positive direction this year, at least this summer, because of the likes of Barbie as well as Oppenheimer. But when you think about the sustainability of where AMC is right now and the content that needs to move in, how big of a concern are the strikes right now?
Sure. I think the strikes are a concern in terms of quarterly box office. Some of the titles, as you noted, are going to be delayed. Some have already been delayed, like Dune out of Q4 into Q1. A Deadpool was removed from the release slate lineup for Q2 24. It doesn't have a new release date yet because they were in production during the strikes, and so they'll just have to wait and see when they can get back to production. But it's just a delay, the way I see it. I don't see it as incredibly harmful to the movie theaters. It's just a delay. So I still think that without Dune in Q4, the quarter can still end up higher year over year, and the year should still end up well over 20%. You have likely a 50% improvement year over year in Q3 ahead of that, and that will be likely the first quarter since the pandemic that you have a positive comparison to a pre-pandemic, 2019 box office quarter. So as the volume of this content continues to rise and improve and get closer to what it was pre-pandemic, these trends are really positive.
But Alicia, I just want to kind of go after this point just a little bit more, dig into this a little bit more, because when you think about even like the Barbie blitz, right? A big part of that was a big marketing push. And I know that's like on the studio side, and that helped get a huge amount of butts and seats. Absolutely. And it made it a great blockbuster this year. And it had that kind of Barbenheimer theme around it as well, with Barbie and Oppenheimer. Without that marketing push, especially, you don't have actors who are able to, lend their star power to these films, any films that are still slated to come out. Forget about the delays we see and we'll start to see more of. Again, that point of just butts and seats. How can AMC continue to perform when it might not have the demand that it needs?
Sure. So I think one of the things that we saw, and the reason for Warner Brothers delaying Dune specifically, and note that they didn't delay Aquaman and they didn't delay Wonka, which are also both coming out in the fourth quarter. The reason they moved Dune is because of the star power. Dune is an old novel. Many of us like it from older generations, Boomer, Gen X, maybe, quite a few millennials as well. But to get those Gen Z moviegoers that are so incredibly important to box office these days, they're the largest group of moviegoers. They really need that social media push from the younger actors. And in Dune has Timothée Chalamet, Florence Pugh, Zendaya, and Austin Butler. If you don't have them using their social media power to get those Gen Z into the movie theater, then you're going to have a real problem. Barbie, you saw really how well that marketing campaign did, and Oppenheimer kind of rode the coattails of that in large part and got a larger audience, people who would not have normally gone to see that. And so that's what Warner Brothers has realized, and that's why they had to push that a quarter, just so they could get that marketing push. I don't think you're going to see that for all of the Q4 titles. You don't need quite that same marketing campaign where the actors are participants. You can still do big marketing campaigns without the actors for some of these Q4 titles. We've yet to see what Lionsgate's going to do about Hunger Games and what Disney's going to do about Marvels and Wish. But if those remain in place for Q4, I think the box office is going to be quite healthy for Q4. And in one aspect, I think for IMAX particularly, this actually helps them for the fourth quarter and for next year.
Yeah, I mean, that's the question. How does AMC stack up against some of its competitors? You mentioned IMAX, but there's also Cinemark. What's the better buy?
Yeah, so the way we look at it, so this writer's strike doesn't impact IMAX all that much. In fact, the push of Dune from Q4 to Q1 is beneficial to them, because before, with Dune, they were not able to play Hunger Games and Marvels. And without Dune in the fourth quarter, they can. They have the capability to play both those titles. And then in Q1, Dune's going to a slot that IMAX didn't already have filled. So this is incremental revenue for IMAX. And with IMAX's expanding global footprint and its foreign language content, in a lot of countries, they're just really well positioned despite the writer's strike. I'd say Cinemark is our next choice. We have an outperform rating on Cinemark. We think their valuation relative to AMC, if Cinemark was valued as AMC is now, they'd be trading at $36, and right now they're trading at $15. So the range that they should be trading at should be $19 to $28. We have a very conservative $20 price target on them, and just being mindful, they have a net debt of $1.7 billion versus AMC's $4.4 billion. They have they're reducing their debt pretty meaningfully in 2023, and they're likely to resume paying a dividend in 2024. So they're just really well positioned to get back to that mid to high level trading range. And so I think they're currently undervalued in the current market.
A very interesting thesis there. I certainly saw a full theater when I went to see Barbie. We'll see if the thesis in terms of the share price for AMC holds up. Alicia Reese, Wedbush Equity Research Analyst. Thanks for joining us. Have a great weekend.
Thanks for having me.
You got it. Coming up, will Bud Light's latest marketing campaign work to get its target audience back on board, or is more backlash set to come? We discuss when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned. into Yahoo Finance.
Bud Light has just launched its new marketing campaign to try and get its target audience back on board ahead of the start of the NFL season. The beer has officially been dethroned as America's favorite this week, and sales have plummeted since April. It comes after Bud showed support for a young trans influencer online, which led to customer boycotts and backlash. Take a look at the new ad.
Yo, Paulie, you want some coffee?
It's really shaping up to be like that type of team.
The defense, too, though?
We gotta hurry up. You know how I get over
Then love at first sight. I forgot the sausage. Oh, my God. I want a Sunday.
Another one today, because the city sure don't need it.
Joining us to discuss further, we've got Marcus Collins, business marketing professor at the University of Michigan and the author of For the Culture. Marcus, what's the verdict here? Feels like this is an ad that's sort of getting back to the roots, if you will. Is this going to be effective in getting some of those consumers who moved away from the brand?
Well, back to the roots is probably an understatement. What we see here at Bud Light is exactly what Bud Light has done years ago, almost a decade ago. Bud Light is basically saying, listen, we know we had a tough summer. You know it too. Let's act like none of that has existed, and let's get to some commonality. You love football. We love football too. This is a perfect occasion for drinking where Bud Light is the official sponsor of the NFL. Let's celebrate a thing that we can all agree on, that football is awesome. And I say all agree with big air quotes. But this spot that you just saw with Bud Light that you just aired, that's not dissimilar from a spot that Bud Light made literally 11 years ago, because I worked on that spot, highlighting, celebrating superstitions or rituals of fandom, and Bud Light being sort of an artifact of that very thing. So this is Bud Light trying to get back to some neutral zone, some commonality. Will it work? It's hard to say. And my gut says no. Because I feel like the opposition of Bud Light still is holding a lot of raw feelings, and of course the people who are alienated by Bud Light, the LGBTQ plus community, they still feel like they've been ignored, and Bud Light hasn't really issued or provided a meaningful apology either way. And ergo, it's creating a really tough situation for the brand, which we see manifested in its commerce.
So, Marcus, I want to ask you to that question about will this work or not, because that is what comes to mind. And I have to admit, not that my opinion matters. I like both ads, actually. And yes, the new one does remind me of, kind of an old, I know you worked on, their old campaigns before today. But I got to ask you, if it doesn't work, what does this mean for Bud Light?
It means Bud Light is going to be in big trouble. I mean, the truth of the matter is that the entire category is declining and has been declining for about a decade, right? So year over year decline. Bud Light had just been at the top of the ones who've been struggling. And what this really signals is that if Bud Light has been dethroned and the category is declining, then it's going to be a pretty tough situation for everyone. Now, Modelo is benefiting, being the new number one at the moment. However, the industry itself is still struggling. So this loss, this pain point that Bud Light is experiencing is one that's going to reverberate to many brands, right? It's the job of the category leader to save the category, and that's not happening. So this is going to be pretty bad. If they lose the football season, it's such a pivotal drinking occasion for the category. If they lose the football season, this is going to be a really tough year for Bud Light, if it hasn't been tough enough already.
What does this tell you about the environment that so many brands have to navigate right now? I mean, we were talking about this in our meeting earlier, that on the one hand, this was about Bud Light expanding its reach. That didn't work, and yet they ended up alienating two core communities, two core markets that they were trying to capture.
Well, it says a few things. I think the first thing it signals is that this idea of talking to the average consumer is a myth. That's not real. What Bud Light did when they did the partnership with Dylan Mulvaney and they got the backlash is that they decided to just play to the middle, to play it safe, completely alienating one group of people they've been supporting for over a decade, the LGBTQ plus community, and then also upsetting the people who initiate the boycott. And instead of sort of standing on a conviction, which Bud Light has had for a while. Bud Light has supported this community, the LGBTQ plus community, for decades. Instead of standing on what they were being convicted about, they decided to play it right through the middle. And as a result, the two sides were not happy with them. And people in the middle said, I don't want to be involved with this. I'll just drink something else. Ergo, Modelo. That's the one thing. The second part of this is that, listen, you're not going to be able to satisfy everyone when you try to elevate beyond the value propositions of your product. What Bud Light and other beer brands have done is try to be more than just an alcoholic beverage in a can. They want to be connected to the consumer. They try to anthropomorphize itself so that they're able to connect with people in meaningful ways, realizing that if people feel connected, they're more inclined to consume and more inclined to be loyal. Well, if we want to, as a brand, play by the rules of humanity, the rules of connection, then just like we expect people to stand for something they believe in, brands have to do the same thing. Otherwise, brands will not be able to fortify meaningful relationships, especially when the road gets rough. So if you can't stand for something and you want to play the middle, then you need to focus on just having transactional-based relationships with people, not trying to leverage culture as a vehicle for consumption.
I'd imagine a lot of brands taking note there based on what played out with Bud Light. University of Michigan professor Marcus Collins, we always enjoy having you on the show. Thanks so much for the time.
It's always a pleasure. Thanks for having me.
All right, Rite Aid reportedly close to filing for bankruptcy protection. Yahoo Finance's Anjali Kamlani and Josh Schaefer are here with the details. Let's start with Anj. Anj, you want to break down this story for us?
That's right. So let's look at what the Wall Street Journal reporting today, that this company, Rite Aid, is preparing to file for Chapter 11 bankruptcy as a result of the mounting debt from opioid settlements that it is due. In addition to a number of headwinds the company has been facing over time, including debt maturities coming up. In addition, we know that the Department of Justice filed a civil complaint against the company, claiming that it knowingly filled these opioid prescriptions and didn't pay attention to red flags. We've seen the company struggle in the last several quarters, announcing store closures last year, 145 total, and more that started this week. So it's really a tough time for the company. It hasn't been able to play sort of on the same field as its competitors, CVS and Walgreens. In fact, it did previously pursue M&A activity with Walgreens as well as the Albertsons, and successfully pursuing a merger there. But also what I thought was interesting was, for several quarters, they have been asked repeatedly about the opioid litigation and about their pending debt concerns. And the company hasn't really said much outside of, nothing new to add. But I took a look through their SEC filings, and I saw that in the third quarter for 2023, for the first time, they mentioned a little bit, they tweaked the sort of commentary that they had around legal proceedings outside of the stock. We could be impacted. And they said, quote, although we believe we have adequate sources of liquidity to meet our anticipated requirements for working capital, debt service, and capital expenditure through at least the next 12 months, the costs associated with these legal proceedings are impossible to estimate with certainty, could exceed any applicable insurance coverage, and could significantly impact such liquidity. And that sort of was the first time that we got any indication that they were looking at sort of mounting debt and concerns for that total of $3.3 billion that they are looking at in debt total. So really just a concerning look for that company right now.
And Josh, to say that things have been challenging for this company is certainly an understatement. You look at the reaction today, the stock down more than 50%.
Yeah, Kiko, you see the stock down more than 50% today, and the stock has not done well over the last several years either, because it's been a struggling retailer. And that's why I think you're hearing that Rite Aid might be filing for Chapter 11 bankruptcy, because they still feel like part of their business is positive. So I spoke with one source who's familiar with the situation and the developing situation here that I'm told is fluid, and some key points to point out here would be that those opioid liabilities would become unsecured claims in this filing. So that would put them to the bottom of the claims that Rite Aid would pay out first. And that's an important thing to highlight because they might be able to essentially write off some of those claims and never actually pay those opioid liabilities themselves. The other thing to think about here when we're talking about retail is the businesses. Now, I'm told Rite Aid could eventually look to close several hundred stores. And when you close several hundred stores, but you do it through bankruptcy, you can reject some of those leases and get out of those leases easier through Chapter 11 bankruptcy that way. And that is a situation that is used throughout retail. You think about some other companies that have done that, say a Neiman Marcus or JCPenney. Filing for Chapter 11 bankruptcy is not necessarily the end of the company's path, but a way to get out of some of the debt that they owe and get back in a better financial situation and come out of bankruptcy in, say, maybe a year. If they were to file in a month, maybe they come out of it in a year as a leaner company and a more direct company and with less stores operating in a smaller, more efficient way. It seems like that would be the overall strategy for Rite Aid here to turn around.
A possible reset there. All right, Josh Schaefer and Anjali Kamlani, thanks so much. Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
And there we have it, the closing bell on Wall Street to round out what has been an eventful week in the markets here. But green across the board to round out the week on this Friday. The Dow up 247 points, the S&P 500 up 29, and the Nasdaq up 126 points. The Nasdaq and the S&P 500, by the way, snapping a 3-week losing streak there. So things ending on a positive note. This coming even despite those comments that we got from Fed Chair Jay Powell out of Jackson Hole, which seemed to suggest that we will be at higher rates for longer, just given where the inflation print has come in so far.
All right. Earlier this week, the Republican presidential candidates minus former President Donald Trump met for their first debate of the 2024 election. The 8 candidates spent a lot of time attacking each other, as well as current President Joe Biden. But what will the most prominent GOP candidate go after Biden for? Yahoo Finance's Rick Newman joins us now. Rick?
Hey guys, Happy Bidenomics Friday to you. The Republican candidates 2 days ago, they obviously attacked each other, but I was also listening for what their lines of attack on President Biden are likely to be, given that President Biden is the guy the ultimate Republican nominee will be facing. And I picked out 6 different things. You see them listed there. First of all, the obvious one is inflation. Now, inflation has been getting better. It's now at an annual rate of 3.2%. But it went as high as 9%. And I think one of the important things regarding voters is a lot of those price hikes that we've seen over the last 2 years, those are still there. We're just seeing a smaller rate of increase. So where will this be by, let's say, a year from now, when we're really heading into the final weeks of the 2024 campaign? That's crucial for President Biden, I think. You also heard a lot of the Republicans dinging Biden on fossil fuels, saying we need to become energy dominant again in the United States. That's a bit misleading because, believe it or not, we're headed toward record production of oil here in the United States, probably by the end of this year or next year. And we're already producing record levels of natural gas. So those were 2 of the headline items. And then a few other things, aid to Ukraine, getting tough on China, immigration, and what Biden is doing on the national debt. But we got a long way to go, of course, because before one of these candidates turns his or her fire on President Biden, because they got to figure out who their nominee is going to be first, and that's going to take many months.
All right, Rick Newman, we'll leave it there. Have a great weekend.
See you guys.
Well, Fed Chair Jerome Powell saying that further rate hikes are on the table at a speech he gave at Jackson Hole earlier today. He also said the Fed intends to hold rates at a restricted level until inflation cools further towards that 2% target. We've got Yahoo Finance's Jen Schomburger on the ground for us in Jackson Hole, standing by with IMF Chief Economist Pierre-Olivier Gourinchas. Jen?
Thanks so much, Akiko. That's right. I'm here on the sidelines of the Kansas City Federal Reserve's annual economic symposium with the IMF Chief Economist Pierre-Olivier Gourinchas. It is great to see you. Thanks so much for joining me.
Thank you for having me.
I want to get your reaction to ECB President Christine Lagarde's speech, which she just gave here at the conference. She says we may be entering a new age of shifts in economic relationships, and that could create challenges for central bank policymakers. Your thoughts on that? She also talked about shifts in terms of investment in green energy, the labor market trends, and countries that are turning inwards, perhaps creating changes in global trade patterns that could lead to inflation shocks.
Well, that's certainly one of the risks that we highlight in our reports, that we see countries sort of moving away from each other. Mm-hmm. We see increasing geoeconomic fragmentation. This is going to be bad for growth. This is going to be bad for global trade. And this could also, by increasing marginal cost for businesses, it could also weigh on inflation dynamics and prevent a speedy return of inflation to central bank targets. So it's certainly the right concern to have. Now, President Lagarde was mentioning geoeconomic fragmentation, but that was not the only source of uncertainty in this new world. Climate transition, the fact that we have a war on the doorstep of Europe, the fact that we're still dealing with the aftermath of the COVID pandemic and all of the shutting down the economy and reopening. These are unprecedented. And in a sense, we need to upgrade our operating system a little bit here to understand exactly what's going on and make sure we're ready for the future.
Are we on a course for an acceleration of deglobalization?
There's certainly some signs that deglobalization could be increasing. We've plateaued in terms of globalization. We're not increasing our economic ties any further at this point, and we see the signs that some countries are putting some trade restrictions, some restrictions on technology transfers, etc. And that is certainly going to weigh down on integration going forward.
Coming back to the economic picture that we're looking at right now, we heard from Fed Chair Powell earlier today. We just heard from Christine Christine Lagarde. You've warned about higher inflation globally that could cause central banks to raise rates perhaps more than thought. After hearing from the central bank leaders today, do you think there is a risk for a higher path for interest rates, and what could that mean for global growth?
I think we're seeing two things when we look at inflation right now. What we're seeing is headline inflation has been coming down, mostly on the back of declining inflation for energy and for commodities. But we're seeing stubborn core inflation outside of energy and food. And that is the concern for policymakers, for Chairman Powell or President Lagarde. And so what they're saying really is they're saying, look, we really need to see some good news on this core inflation, these underlying inflation pressures. And it's not quite there yet. We're seeing a few good signs. Chairman Powell mentioned we had 2 good reads in May and June. That's not enough. So we need to see a consistent pattern. And so the risk there is that if some of these inflation pressures remain elevated, then central banks will have to do more.
And that could cut into growth. Speaking of which, you upgraded your outlook for growth, about a month ago. How are things trending now? What's your outlook for global growth now?
Well, what we're seeing now is a little bit of a divergence in a sense. We upgraded our growth forecast for 2023 by about 0.2 percentage point in July in our latest report. And part of this was the strength of the U.S. economy that has been coming more strongly in the last few reads. And that is confirmed. What we're seeing now is a U.S. economy that is actually quite strong and quite resistant. Strength of the labor market, we see strong consumption, etc. What we are seeing on the other side is we're seeing a weakening of the Chinese economy. We're seeing also potentially some weakening of the European economies. And so that is probably overall going to land us in a growth pattern for 2023 and 2024 that's going to be relatively weak.
You mentioned China. We're dealing with inflation here in the United States. Certainly Europe is as well, but prices in China fell last month. You're seeing weakening in that economy, China's central bank cutting rates. What is the risk that China's economy is stalling or worse could fall into recession, and how does that factor into your outlook for growth?
Well, the Chinese economy had a strong rebound in Q1 after they reopened and lifted the restrictions related to COVID. But that rebound has not gathered enough momentum, and what we're seeing is a slowing economy. That's on the back of two things, really. One is we have, as I mentioned, a weak global growth. And China is a big exporter. It's a big producer for a lot of the goods and manufacturing goods that are sold all over the world. And so if the world economy is not growing very strongly, there's not going to be very strong demand. That's going to weigh down on Chinese growth. The second factor, of course, is the property sector. And here what we've seen in recent weeks and recent months is that property sector, the problems are still there. They're not solved. So that weighs down on consumer confidence in China, that weighs down on investment, and so we are seeing an economy that is a bit weaker than we'd like to see.
In terms of China's weakness, do you think this is a cyclical economic problem for them, or is this structural? In other words, as we've seen, we're talking about shifts in the global economy here post-pandemic, as we've seen countries shift their supply chains away from China, is this the beginning of a change in growth cycle for China?
Well, certainly the property sector, this is more of a cyclical component. The weakness in global growth, that's more of a cyclical component. But you're right to point out that there are some clouds on the horizon for the Chinese economy beyond just this year and maybe next year. What we are seeing is also more of a slowdown in the growth numbers, looking 3, 4, 5 years out. And it's, in a sense, the challenge for the Chinese economy is how to reignite the engines for growth that don't rely on just building more infrastructure, building more housing, more property sector development, that is really driven by internal growth and re-engage into the global economy and sort of being able to reap the benefits of a faster growing global economy when it comes.
Do you think China's exhausted its growth playbook, right? It's playing what it's done historically now for over a decade at least, maybe 2, right? They're doing infrastructure, they're cutting rates, they're trying to stimulate borrowing, build it and they will come. You talk to the fissures in the property sector. Is the playbook no longer going to work this time around?
No, I think it just needs to be adjusted. There are a lot of reforms that the Chinese economy can implement, Chinese policymakers can implement that would help growth, domestic growth in particular, to be stronger. And so I think what we're looking forward is to see some of these more structural reforms being implemented that will allow the Chinese economy to get to the next stage in its development strategy.
All right, well, Pierre, we'll have to leave the conversation there, but thank you so much as always for your insight. I so appreciate it.
My pleasure. Thank you.
That's Pierre-Olivier Grinches, Chief Economist of the IMF. Akiko?
Okay, Jen Schomburger, thanks so much for that. We're going to come back to you for more coverage from Jackson Hole. Coming up, we are heading out to Jackson Hole again to break down the latest comments from Fed Chair Jerome Powell. Stick around for more here on Yahoo Finance on the other side.
Well, Fed Chair Powell gave his major monetary policy speech this morning right here in Jackson Hole. For more reaction to this, I want to bring in Alan Blinder, former vice chair of the Federal Reserve and economics professor at Princeton University. Professor, thanks so much for joining me.
Glad to be here.
So I just want to kick off the conversation. Your reaction to Fed Chair Powell's speech?
I think he accomplished exactly what he wanted to accomplish, which is not to tip the hand of the Fed in either direction. If you wanted to find snippets that suggested hawkishness, you could find them. If you wanted to find snippets that suggested dovishness, you could find them. If you asked me to break the coin flip, I would put it mildly to the hawkish side. Not much, mildly.
So,
but, you know, I could see someone reading it the other way.
So given that what you just said, we also heard again from Chair Powell that the Fed is very data dependent. You look
Absolutely.
You look at the data though, and it's been quite strong. So does that create upside to the current rate hike path that was laid out in June?
I'm going to half agree with you. If you look at the real data, real economy data, employment, GDP growth, et cetera, it looks like upside risk. But we have come through a long period now with the economy strong, growing faster than trend, creating jobs like mad, the unemployment rate flat as a board, and inflation's been coming down. So the other data dependence is on the inflation data. And I'd actually personally, and I think the Fed would, put more emphasis on that. If the current miracle that's being called immaculate disinflation keeps up for another 6 or 8 months or something, the Fed will have achieved somewhat miraculously a perfect soft landing at 3.5 or maybe 3.7, whatever it is, unemployment rate, and inflation where they want it to be. So the inflation data have been very good.
So where does that leave things for the September policy meeting?
That's sort of where I started. I read this as just a tiny bit on the hawkish side, which would suggest another 25 basis points. I hope they don't do it. I don't think they need to do it. I think they should pause and maybe pause for a long time and maybe be finished raising. But he did emphasize a few risks, to upside risk to growth, upside risk to inflation. And if those come true, that it's not going to be, it'll be a short pause. They will start again.
They'll start again. Fed Chair Powell pointed to lags, and he thinks that we're going to see those bite harder than we have so far. What is your sense of how long the lags are in this cycle? Do you think the economy has remained so resilient as it has in the face of 11 rate hikes because perhaps the lags are a bit longer this time around?
I wouldn't go that far. If you go by past history, and what else do we have to go by? The lags have been very long. From monetary tightening to a real bite on the economy, a year to 2 years. On inflation, another year after that. It's easy to forget the Fed only started tightening in March 22, and at first it was kind of very slow, and then they speeded it up quite a bit. So it seems to me, and I believe he said that, I don't have the text of his speech in front of me, that there are significant effects still in the pipeline from what they've done already. And that, to me, is one of the major reasons to pause. That's what I would think they should do, because we haven't seen the full effects, certainly not on inflation, of what the Fed's already done.
You talked about the prospect of a soft landing. That seems to be more people are coming around to that scenario. Right, fingers crossed. Yeah. If they don't end up moving into that extended pause that you'd like to see in September, and they end up doing at least one more rate hike, given the lag effects we just talked about, where could that leave the economy? Does that raise the prospect of a recession?
It does. Now, if we're talking about one more 25 basis points. A number of people over the years have called that chicken feed. That's not going to make the difference. Either they're already on the verge of having done too much and another 25 is just a little piling on, or where the worry is that they will look at the data and say, inflation is still 3, we need it to be 2, and pile on more rate hikes, which turn out to be too much in retrospect. We'll only know that after. So I don't worry so much about a single decision. You know, what I said just a moment ago is that I hope they pause. I hope they paused in July. They didn't. But 25
So they've already starting to overdo it.
They may be.
Okay.
The problem with this is you only know later. You look back.
Right, hindsight's 20/20.
Hindsight is even not 20/20, but it's a lot better than foresight.
I want to ask you, before we wrap up, your thoughts on long-term Treasury yields, because those have jumped to the highest level since pre-financial crisis, and we're seeing real yields bump up to around 2%. If we're to get above 2% on real yields, is that going to be problematic for the Federal Reserve?
I don't think so. I think they probably think of it as part of the mechanism by which their policies affect the real economy. You know, the meeting announcements after each Fed meeting are about the federal funds rate. Hardly anybody cares about the federal funds rate. There are almost no transactions at the federal funds rate. It's what about the 3-month T-bill rate, the 1-year rate, the 2-year rate, the 10-year rate, and the stock market and the exchange rate. That's the way monetary policy gets transmitted into the real economy. They surely expected when they started raising interest rates that long-term rates would go up. They have gone up. They're still, this is something that a lot of people forget, they're still not very high by historical standards. If you look at the broad sweep of, I don't mean going back to 1802 or something. Let's just look at the post-war period. These interest rates are fairly low compared to the average of the post-World War II period. So then they're higher than they've been.
They're higher than they've been, but you mentioned the 10-year, and that obviously impacts the 30-year mortgage rate.
Absolutely.
And we're now over 7% on mortgage rates. People are feeling the shock. And my question is, do you think we're finally going to see prices reset, or because there's such little inventory on the market and people are loath to sell because they're going to have to pay 7% mortgage rates, we don't see the reset in the housing market?
Yeah, that delays it. But if you're sitting at the Fed and you're raising interest rates, what you're probably thinking is we're going to impinge mostly on 2 markets, automobiles, which also has not really moved down very much, and housing. So you're expecting to do that on housing, and the mechanism is what you said. Higher bond yields lead to higher mortgage rates. And if people are not responding, one of the risks that could lead to over-tightening is they see people don't seem to be responding enough to take enough steam out of the economy. They go higher and higher and higher until they find out, whoops, we went too high. Now, are we there now? I'm slightly worried, but not too much worried that maybe we already are. You don't know immediately.
Right. Well, we'll have to check in with you in the fall. Professor Blinder, thanks so much for your insights.
You're
I appreciate
very welcome.
it. Diane.
Another great interview with our Jen Schonberger there in Jackson Hole with former Fed Vice Chair Alan Blinder, who basically told us something for everyone in that Fed speech at the top of the day today. Meantime, major tech companies are bracing for the impact due to be brought on from the EU Digital Services Act. Here to break down how this could change the online market space is Yahoo Finance's own Dan Howley. Dan, take it away.
That's right, Dan. Diane, the Digital Services Act is going into effect today, probably already in effect in Europe, obviously, with that time change. But what we want to talk about is some of the changes that are coming to companies, or companies are going to have to begin putting into place as a result of this. And some have already been working on this, these changes before, working with the EU to ensure that they're complying with these rules, which they must comply with or face stiff penalties. So we'll just go over some of them real quick. We have they have to have measures in place to counter illegal goods and services that are sold through their platforms, whether that's on Amazon or Meta's marketplace, Meta's Facebook marketplace. They have to provide traceability of business users. So if there are counterfeit goods, for instance, we've heard about that being an issue on online marketplaces. These companies now, the online platforms, have to provide a way to trace these businesses to ensure that those illegal goods are then taken down. They also have to have transparency measures put into place. They have to provide researchers with access to their data. They have to be transparent about the types of algorithms they have. And they also are no longer able to market towards teens based on some of their existing profile information, basically just the fact that their teens is the only thing they can use. You can also now, and again, this is all in the EU, opt out of algorithms. So you don't need to use algorithmically driven versions of websites, whether that's Meta, Instagram, X, what have you. You can just see a chronological order of people that you know, rather than an algorithmically driven version that's meant to get you to want to engage more with unknown users and have you spend more time online. They're also supposed to stop using so-called dark patterns, which are basically a means of designing a product to get people to want to use it, perhaps sign up for a service or buy something that they otherwise wouldn't do if those dark patterns didn't exist. So this is all something that the EU is forcing companies to comply with. If they don't, again, they'll face stiff penalties, the worst of which would be perhaps being kicked out of the EU altogether, though you can imagine the companies won't want to go that far. Amazon is already trying to challenge the rules on its own, saying it doesn't belong in a certain category of them. But any big tech company that you can think of is involved in this. Apple, Microsoft, Google, Amazon, Meta, X, the entire like. So if you're a big tech firm, you're paying close attention today.
Oh, absolutely. Big tech definitely doesn't want to be kicked out of the EU. Thank you, Diane Howley. I'm just kidding, Dan. I had to get that one back in. Have a great weekend, Dan. All right. Coming up, the robust construction of new apartments is falling short, especially on the West Coast. We tackle the latest housing hurdles. That's on the other side. The robust construction of new apartments is falling short, especially on the West Coast. Data from CoStar shows that developers in that region are on pace to build less than what was produced in 2021. We want to bring in Yahoo Finance's Danny Romero with the latest. Danny?
Dan, this isn't a pretty picture for the West Coast that is dealing with the housing shortage, but also the impacts are rippling into other markets. And how bad is this situation? Well, let's put this into perspective. Developers are on pace to build about 32,000 apartment units by the end of this year across Los Angeles, San Diego, San Francisco, San Jose, Seattle, Portland. That's about a 20% drop from 2021 levels. So far this year, the apartment starts hit over 10,000 units. And if we compare that to the first half of 2021, over 19 units were started during that period. So that's about a difference of 10,000 units. What is causing this? Well, there are several factors that are weighing into this issue. Well, for one, developers are having a hard time when it comes to lending, getting loans, getting funding for some of these projects, and also construction costs have been rising. So that is really weighing and dampening the momentum when it comes to building apartments. So what does this really all result to? Well, experts have been telling me that we probably are going to see an impact on rents, that rents could probably triple about 30%. So rents will likely end by the end of 2025. If we want to put a dollar figure to that, the average renter could be paying $1,500 more a year on rent costs by the end of 2025. So really not a pretty picture.
Affordability clearly still the issue. Zillow trying to lend a hand, trying to provide a lending hand. This one makes me a little nervous, Danny, in terms of the program they're offering. Walk us through the details.
Zillow is beefing up the mortgage competition. And how does this work? By offering a 1% down payment for potential home buyers. So how does this really work out? Well, a potential buyer will pay about 1% towards its down payment, and then Zillow will pay the additional 2%, bringing the total down payment to 3%, which is needed for a conventional home loan. And this comes as mortgage rates have been hovering well past 7%. And so not everyone can jump into this. It's only available for buyers in Arizona. But remember, Zillow has tried to be ambitious before in 2021, and it didn't work out so well for them. Akiko.
Oh, well, we'll certainly see what happens with this. I do think it's an interesting concept, especially when we think about the affordability issue when it comes to the housing, just all the issues we have within the housing market now. So it'll be interesting to see if it works. Yeah. I hear Akiko's concern, but I actually think it might be a good idea.
Well, they're trying to be ambitious, and Zillow has been ambitious before, like I said, in 2021. Right. But again, giving the lending downturn that has been happening on the mortgage front, I mean, we're seeing it like we were talking about when it comes to construction, lending. So, and affordability is a big issue at hand. So obviously the home builders have been offering mortgage rate buy downs. So it is attractive, but depending on how well this works out might be the issue at hand.
Time will tell. All right, Danny Romero, thank you. All right, coming up, more of Yahoo Finance's coverage of Jackson Hole on the other side. Stick around.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. Well, every year the Kansas City Federal Reserve puts on an annual economic symposium here in Jackson Hole, bringing together central bankers, policymakers, academics, and journalists. Joining me now is Esther George, former president of the Kansas City Federal Reserve. Thank you so much for joining me.
Thank you. It's good to join you.
Welcome back.
Yeah.
after having retired. Before we get to what you've been up to, your reaction to Fed Chair Powell's speech this morning.
Yeah, he met my expectations. I knew this would be a widely anticipated and watched speech. And so I think for him, very important to reinforce messages that he's been giving and that the committee's been giving, which is we remain squarely focused on that 2% target. We see how the economy is performing, and there's some uncertainty here. And so we want to make sure that markets, that the public know we haven't given up on 2% and we'll continue to watch that.
Many have said that he was moderately hawkish. We know that the Fed is data dependent, and Chair Powell emphasized that again today. If you look at the data, it's been quite strong, quite resilient. Do you think that spells a higher rate hike path than what was put forth in June?
Well, I think if you listen to his remarks today, he laid out a couple of options there to say it could mean more rate hikes down the road. It could also be a call for patience. And if you think between now and the September meeting, there will be more data that comes in. I think that's going to inform how this committee thinks about what the next steps were. We've heard today about the uncertainty. People are very pleased, as am I, that the economy looks resilient today. But there are lags to this policy, and a lot has been done that I think this committee, wisely, is wanting to see how it unfolds.
Chair Powell says he's encouraged on inflation, but there's still a lot of work to do. We're going to get a couple more inflation reports between now and the September policy meeting. Do you think that's going to be enough for the Fed if those reports come out as the last couple have to move into an extended hold, or do you think they would opt to wait till November and collect more data?
Yeah, I mean, if it were me, I think you could wait till November. I think he made the point today, we've had 2 months of data that we're encouraging, but it doesn't yet make us convinced that we're on the right path. And I think one of the lessons from past committees is you don't want to declare victory too soon, that you want to keep your eye on that inflation and really have a level of confidence. So I think there could be a number of things. They'll be watching the labor market carefully. They'll be watching those data prints on inflation. They'll be looking at what's happening in the broader economy to try to understand where they might be.
And to your point on the labor market, Powell said if we don't see further easing, that could require a monetary policy response. So obviously inflation has been the number one thing that the Fed and much of the markets have been focused on. But if the labor market remains strong, what do you think that spells for policy action?
Well, the labor market's an important indicator of the health of the economy. It's very tight right now. There's been some softening. I think one of the things in the anecdotes they hear is that businesses are less concerned about some of the very aggressive wage hikes they had to make, which may mean there's better balance coming in between workers' expectations and inflation. But job vacancies have not softened the labor market enough to bring inflation down. So I think these imbalances that have been the theme of this conference are going to be really important to watch. Supply is helping some. The Fed has a job to do with its rate increases. How much more? I think they're being very open to watching the data.
So to your point, you know, getting to the peak on rates is one thing. How long you hold for an extended period of time is another. How long do you think the Fed will remain on hold? Do you think we'll see really a 5 handle on rates for through 2024?
Yeah, I'll be very interested in the SEP or those individual projections that the committee will submit in September. I think even the last set of projections suggested people thought 2024 would allow them to begin to back off of some of those rate increases. So that's why I think the coming data releases are going to be really important to them to gauge, are we holding longer? Really, I think the experience of this past year has been to push out some of the concerns, you know, whether it was worried about recession, where it was worried about, you know, pain in the labor market. that continues to be pushed out. And it could happen again, I think, with this next set of projections.
So we've seen so much resiliency. People are now calling for a soft landing instead of a recession. How much longer do you think we can continue with this? I mean, no one canceled the business cycle, right? So what's it going to take?
So one of the things I think about are the lags. And there's, been a debate about whether they've shortened because of financial markets and communication by the central bank. And that may be the case, but I think there is still more to come. When you think about how aggressive last summer the committee was, they've made additional hikes, that I think you're going to have to wait and see. That can take up to 18 months, which suggests we may be through the end of the year before we begin to see further effects. And that's why I think there's a good case to be patient right now before you make a call on whether more rate hikes are needed.
Switching gears, I always like to ask women in economics this question. Saturday is Women's Equality Day, and there still exists a major pay gap. Women are making 83 cents on the dollar versus men who are in full-time positions. What is your thoughts on how we can close the gap?
Yeah, I think women have to continue to do what they've been doing. They've made progress. I think they are getting more visibility. I think companies are beginning to see the opportunities, ways to include women. We've done that at Jackson Hole in terms of bringing more visibility. So I think those are going to be the kinds of things where skills are in high demand. This is a time of a tight labor market that you would hope to see some of those kinds of gaps closing. But it's an important issue. It's one that's been with us a long time, and no silver bullets on how to address it other than to keep it in front, I think, of the public's attention.
Well, Esther, thank you so much for your insights. Great to see you here at Jackson Hole.
Thank you, Jen. Appreciate it.
That's Esther George, former president of the Kansas City Federal Reserve. Back to you.
All right, Jen, thanks so much for that. And we'll check back in with you in just a few minutes.
All right, we want to do a check of today's top trending stories. I'm going to bring in Josh Schaefer shortly. We're starting with a Tesla charging with a side of fries. So here's the deal with this. So Tesla has apparently won permit approval for its diner and drive-in movie supercharger. This would be in LA. This is according to Teslarati. It's a blog that's seen documents from the LA Department of Building and Safety. Now, Tesla's been kind of talking and teasing about this for years of a drive-in movie theater and diner supercharger. And Akiko, I know you have a lot of thoughts on this. You've seen this. The idea with this is there's going to be some screens that will show movie clips, because I was wondering if it's a supercharger, what's the need for movies, right, Akiko?
Yeah, 30 minutes, that's it for a full charge, right?
Exactly.
But you mentioned Tesla having this in the works. The idea of having a drive-in at a charging station has been talked about even outside of Tesla for many years, because the question is, when it takes 30 minutes for a level 3 chargers, that's the fast chargers, and then even more, we're talking hours for a level 2 charger, what is the experience going to look like? You remember last year, Starbucks announced they're going to have chargers at some of their Starbucks stores. That's where they raise the question, are people going to just be grabbing coffee? You need a place to kind of wait around, right?
It's true.
While you're getting the car charged. And by the way, Diane, I was going to say this. As a person who lives in LA where there are chargers everywhere, it's always interesting to me to see how drivers spend their time while they're waiting for their chargers. True story, I heard recently that there are dates happening at charging stations to say, look, I'm charging in your neighborhood. Do you want to come out? I'll be sticking around for a few hours.
Well, I'll tell you as a personal story. So I took a vacation in July, and so we rented a Tesla just to have the experience of some of my family. We rented a Tesla to kind of see what the experience was like, right? And so my brother-in-law and my sister took it out for a spin to charge it and went on a date while it was charging, because where we went, there weren't this plethora of superchargers around. So they were like, okay, there's a supercharger here. We're going to go on a date while we do this. So it is interesting to see this, and I want to bring in Josh Schaefer and Brooke DePalma, who are here as well, with their thoughts on what we think of Tesla with a side of fries.
It's Elon pitching what he wants people to do with the chargers, right? He wants people to see this as a business opportunity because you can create a captive audience. It's a very smart marketing play, in my opinion. You can show people that, hey, if you put a couple chargers here, you're guaranteed to have someone sit there for 30 minutes. And like Akiko said, then they probably buy a cup of coffee while they're sitting there for 30 minutes. I think he's sort of saying, if you are Starbucks, you almost want to have chargers. You want to have chargers because then people have to sit there. And if I have to sit somewhere for 30 minutes, I know I'm at least having a coffee.
Yeah. Right. I'm seeing more of an hour wait that it takes for a Tesla to charge up. So I don't know. 30 minutes seems kind of quick. It seems like Elon Musk.
2 cups of coffee then. Even better for Starbucks. Right?
In addition to that, I mean, we've seen other companies do this. I mean, in my local mall, there's an Olive Garden right nearby, and they have Tesla charging stations. We also have Mercedes, Rivian, Porsche. They also have teamed up with local companies to really build out those charging stations. I mean, I'm thinking more of like a Shake Shack, a McDonald's, a Chick-fil-A in this sort of charging station area. But what I'm interested in is what kind of food will be at this Tesla diner? I mean, who is supplying the food? Are we teaming up with the national chef? Are we teaming up with a local Shake Shack? What's happening here and what kind of offerings?
Akiko's going to go to find out, right, Akiko? That's why we have Akiko in LA.
Yeah, you know what? Guys, I was going to mention this. There is a Santa Monica station. I think this is the largest Tesla charging station. We're talking well over, 30 chargers there on the lot. There is a code that you can punch in if you are a Tesla driver that allows you to go inside. The bathrooms are all clean because it's just Tesla drivers. There's vending machines available. So, in many ways, Tesla's already sort of selling this exclusivity that it's not just about the car. There's an experience that's attached to it. This feels like an extension of it.
Feels like an extension for sure.
I agree. Absolutely. I mean, yes. But it feels like an extension of it. And Akiko, I also agree with your earlier point, though. It doesn't make as much sense for the supercharger, but clearly they're trying to build an experience around this.
Yeah, and it sounds pretty costly too, Akiko. And I know that you're very familiar with the cost of childcare. We're seeing childcare jump recently. It's up roughly 6% in July compared to a year ago, and that's outpacing the cost of inflation, or rather the rise of inflation. And now with federal funding set to close, this is a story I'm taking a closer look at. It's been on the Yahoo Finance page this Friday. And now with federal funding, it's set to expire in September. Staff shortages also impacting school, daycare, preschool as well. And so really these companies like Bright Horizons weighing in on the impact that the end of this federal funding could have, and something else, really costly that's hitting Americans right now.
Absolutely. I mean, listen, like Akiko, I'm a mom too. So even if you have a child who is in school, you still have to factor in the hours that they're out of school for childcare costs. And, for a good childcare provider, of course, you're going to pay up, but you do feel that pinch. And each year the costs rise, whether you're talking about a sitter, which I love mine. So, well,
shout out to Diane Sitter, you're doing great.
She's amazing. And her sister, who's also a sitter sometimes. But it's, it's a cost that you just have. It's a have to. It's a need. It's not a something that you can kind of just forego. And we've talked about this before.
The graph that we showed at the beginning is what really stands out to me when you compare it to the rest of inflation, because I think that's where we are in the inflation story now. I know Hamza Shaban, who wrote this story that's up on our website right now, this is something that's important to him and something he was experiencing. I started talking to him about it before he started reporting on the story. He's like, this is pretty crazy how much I'm paying for childcare right now. Wow. And I think that's where we are, Akiko, right now in the inflation story is, yes, inflation is coming down. Everything seems to be coming down a little bit, but it's the little pockets that matter to people, and every little pocket is going to matter to someone differently and matter to them more. But I think that's where sentiment is going to be interesting to watch over the next year or so, because some prices in certain areas aren't coming down and people are feeling that pinch more than maybe other people.
Yeah, I mean, no question. This is one that certainly, hits close to home when you think about just how much it costs for childcare if you can get it. I mean, that's sort of the starting point. We've heard of, the long waiting list to get into a place like Bright Horizons as well. But what's interesting about this story particularly is we're talking about one of the very last pandemic era funding programs that are still in place, $24 billion roughly for childcare that helped pay for wages, that helped some of these childcare facilities higher up. And you have to wonder what happens when that funding dries up. Brooke, you mentioned Bright Horizons. They mentioned it recently on their earnings call, saying they're going to take a hit from it as well. But, childcare workers, they don't get paid a lot.
No.
So
the spread there is unbelievable.
Unreal.
The average hourly earnings, when you look at it, it's $33 for all private sector workers, and then you go down to childcare workers, and it goes down to $20. I mean, that's just a massive spread. And until you close that gap, I don't see how you fix the problem of getting more people to working childcare. That's just a flat out massive gap.
Right. How do you recruit talent in this sort of environment where they know that they could find other jobs elsewhere? And also, too, when you think about these sort of companies that are really facing this issue, it's sort of they have no control over it. I feel like they have no control over how much they're able to pay their employees. The only answer is them raising the cost for parents. So then it's a circle. We're going in a cycle here. It's an ongoing issue that is getting out of hand now.
And just one last number to leave you with, $17,171 a year. That is the average cost for commercial daycare in big cities. So, I mean, that just tells you how much you have to pay up to get that childcare if you can get it. But certainly a topic that we can go on for a while to be discussing. Brooke and Josh, thanks so much for joining in on the chat on this Friday. Well, coming up, it is closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set for everything you need to know later next week. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space. Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
We are wrapping up coverage of the Fed's annual economic symposium in Jackson Hole, Wyoming. Chairman Jay Powell striking a hawkish tone in remarks earlier today, saying more rate hikes are still on the table. Yahoo Finance's Jen Schomburger has been leading the coverage for us on the ground. It's been a busy 2 days for you, Jen, but you've been having conversations with Fed officials, top policymakers. What's been the main takeaway?
Yeah, hey there, Kiko. Well, let me just tell you that it just started downpouring here in Jackson Hole. I was on our air, not less than 10 minutes ago. It was sunny skies. I'm telling you that we have experienced 4 seasons just today. I mean, it was 45 degrees this morning. I'm in a coat. Now it's summer and it's raining. Just an interesting experience. The weather aside, though, I was really struck by Powell's comments this morning because he really had his Volcker moment last year here in Jackson Hole, taking a strong stand on inflation. And then this year, right at the top of his speech, he basically referenced that speech and said, well, my speech today is going to be a little bit longer. My message is the same. The Fed chair really keeping the door open for further rate hikes as needed. So that was the first big takeaway from my experience over the past couple of days.
And Jen, I want to ask you, in terms of analysis from the guests that you've talked to, whether, the Fed watchers, former Fed officials, what has stuck out to you in terms of their assessment of Fed Chair Jay Powell's approach going forward? I know Alan Blinder said, it's kind of, there seemed to be something for everyone. You could take out that it was a hawkish tone. You could take out that it was a dovish tone. To me, it seemed a little bit more hawkish. But what's the general kind of consensus that you're hearing?
Yeah, I agree with you, Diane. I took sort of the hawkish tone from it, but as you mentioned, Blinder telling me you could go either direction. And there are certainly differing views within the Fed, too, because Powell, while he came out, like we said, perhaps hawkish. I spoke with the Philadelphia Fed President Patrick Harker earlier today, and he is of the mindset that if the next couple of reports on inflation come in like the last two, then he would feel comfortable moving into an extended hold for the September policy meeting. So I think the Fed has the ultimate destination is the same, but how you get to that destination, right, is differing within the FOMC itself. And, you know, as far as the folks that I've been talking to here on the ground, they also are saying, you know, it's really going to depend on the data. The data has been stronger than many have expected. The economy has been more resilient. And speaking with former St. Louis President James Bullard earlier this morning, he thought that there could be more upside risk to the rate hike path.
Okay, well, great coverage on the ground there. Our very own Jen Schomburger. Try to stay dry. We can hear the rain from here, but try to stay dry out there.
You
Thanks
can hear
so much.
it. Thank God I'm covered. So, yeah, thanks, guys.
All right. It is closing time here on Yahoo Finance. Let's recap some of the top stories of the day. Fed Chair Jerome Powell striking a hawkish tone in a speech from Jackson Hole this morning. He says further rate hikes are on the table and says the Fed intends to hold rates at a restrictive level until inflation cools further toward 2%. Grocery delivery app Instacart filing to go public. The latest sign the IPO market is starting to thaw. It will list on the NASDAQ under the ticker CART. Instacart is the biggest U.S. online grocery delivery company. The shares of Hawaiian Electric plunging today on a number of headlines, including a lawsuit citing the company's alleged negligence over the devastating Maui wildfires. The move lower also coming as the company announces it's suspending its dividend in the third quarter to help shore up its balance sheet.
And here's what to watch next week. It's a quiet day on Monday, but on Tuesday, we'll get the latest reading on consumer confidence. It comes after Michigan's consumer sentiment slipped in August. Ahead of the open on Tuesday, we will get earnings from both Best Buy as well as Big Lots. On Wednesday, tech is going to be in focus. CrowdStrike, Salesforce, and Okta all reporting after the closing bell. And on the economic front, we're going to get the first look at jobs data ahead of the monthly jobs report with the ADP private payrolls number. And we'll also get a reading on pending home sales. On Thursday, we'll get a closer look at inflation as we get the monthly PCE report, which is, of course, the Fed's favorite or preferred inflation gauge. On the earnings front, Dollar General and Lululemon both reporting after the bell. And finally, on Friday, jobs will be in focus with the August jobs report. The estimate for 175,000 jobs added, which would be a decline from July. And between the jobs number and PCE report, investors may get more clues as to what the Fed could do at this September meeting. That'll do it for today's Yahoo Finance Live. Be sure to come back here on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend.
Have a great weekend.